Welcome to the weekend update. This is being prepared Saturday, June 6th. We will look at the action in the market for June 1st through the 5th, and then see how things look for Monday, June 8th through Friday, June 12th. So I hope everyone had a good week. We actually saw some excitement in the week uh, that just passed, and we'll see if that bleeds over into the coming week. Also, as I'm recording this, it's early in the morning, but I have my windows open, and so you're probably going to hear some traffic going by. But I want to get a nice breeze going in here, so um, that's just one of the shortcomings that we have to deal with for right now. But to look at the week in review and what happened, we did it was a lot of treadmill action where we did a lot of running. It appeared like we were going somewhere, only to end up where we left off, basically. So from last Friday to this Friday wasn't that big of a deal, but we saw some big things happen. And it's not necessarily being measured right now in terms of price movement. It's how price is moving and the volume that we're seeing in conjunction with that movement that's really telling the bigger story right now. So on Monday, the S&P had a modest gain. It was up slightly. It's kind of a boring day. Um, what had happened that night, the night before the market opened Sunday evening, China advanced 4.71%. There's been a lot of stories coming out of China lately where they're changing their margin requirements. They're seeing a real increase in trading volume over in China. And there was one chart that I brought up earlier in the week that shows that it's starting to get to levels that are seen in the US, where we're seeing a real trailing off of daily volume in the US, but a real increase of volume, daily volume in China. I wouldn't read too much into that. I think it's the drop off in the US is more having to do with an exhausted bull market and that we're coming into the summer months. And China is just relatively new, so to speak, as far as being a player in the world stock market arena. And so I wouldn't read too much into that, other than it's kind of interesting to see it happening. Um, on Monday, and this has gone back and forth all week, this whole situation with Greece, and it's still not resolved. They just bought a little more time as of Friday. But on Monday, a rumor was starting to float around down on the floors of the exchanges that said that Greece had reached some kind of a deal, and only a few minutes later to have that refuted. Basically, we saw some of those rumors last week, we saw them the week before, and they've kind of taken the oh, and you can hear the train whistle going too. That'll be real added feature here. Um, but those rumors have been floating around as they're trying to figure out. You've got the IMF and the central banks in Europe on one side, and you have Greece on the other side, and they're trying to reach some kind of a deal, which again seems strange to me because usually when you borrow money from somebody else, you don't get to set the rules. But apparently, when you're a country, you can. So, um, on Monday, it was a fairly positive day where 8 out of the 10 sectors were positive. I'm going to start putting that in the daily highlights each day, how many of the sectors were positive or negative or what have you, because that gives us another little glimpse inside of how the overall market is acting. And we had a lot of reports that came out on Monday economically, but they really weren't big movers as far as the market was concerned. But we had an up day and volume was lighter, and I still screwed this up. I screwed it up on Monday's slide and I screwed it up here. Volume was lighter than volume. That's good. Yeah, no, volume was lighter than average on Monday. I'm just copying and pasting the same slide that I used on Monday, and I screwed it up then, so I screwed it up now. Then on Tuesday, the S&P saw a modest loss, and but usually what I mean by modest is less than 1%. That's kind of my own benchmark for if we're over 1%, that's usually significant. If we're under 1%, that's modest. So we had a modest loss on Tuesday, but what happened, and I'll bring this up in the 10-minute chart, was that the S&P found pretty solid support at 2100, which is also the current level of the 50 period moving average or daily moving average, DMA. And we saw, and I think it was also an R level, no, I'm sorry, an S level as well. And so we're seeing a lot of convergence of different time frames and different calculations all landing at 2100. And that ended up becoming pretty solid support, and the market was able to bounce up off of that. We saw that last week as well, um, at some different levels where the market put in double bottoms, and that's usually a sign of strength, that it makes a bottom, goes up a little bit, comes back down, tests that bottom, and then is successfully able to bounce up off of that level. The only problem is we broke through that on Thursday, and what was once pretty solid support now becomes pretty solid resistance, and so that's more negative. It was positive at the time, but then as the story played out this week, it's now become more negative. The situation with Greece again continued on Tuesday, where both sides are talking back and forth and coming up with their own side of what they think should happen. And what has been happening also over in Europe is a thing called quantitative easing, which is something I explained it in Tuesday's video. But basically, the the Fed on the U.S. level, I'll explain that first. The Fed, instead of buying shorter term treasury bonds or bills or notes or what have you, um, they buy longer, and they buy these from commercial banks. And this buying makes the bonds go up. It also gives money to these banks, which hopefully turns into liquidity, meaning dollars, and banks are more willing to then loan out that money. That money then hits the economy, and then it's supposed to help the economy recover. Well, we've gone through QE1, QE2, QE3, and so forth, which is something that the Fed said they would never do, but they've raised it, or they've lowered interest rates about as far as they can go, and the economy was still stagnating. So it's like, what else do? We can add more money to the economy. So you got the printing presses back there churning 24 hours a day, printing out new money that is no longer backed by anything in the United States. That's known as a fiat currency. We used to be on the gold standard, where all dollar bills basically were backed by an amount of gold. And in 1973, thank you to President Nixon, we were, I think it was 73, when we were taken off the gold standard. In fact, before then, it was actually illegal for Americans to own gold because it was being used to back our currency. And that kind of changed the whole dynamics of the gold dollar relationship. Now it's backed by the full faith and credit of the United States government, where a lot of people are losing faith in our credit, but we still maintain the position of supreme financial leader in the world at this time. But we're seeing that start to weaken over the years as well. And China is starting to really rise up. Germany's doing pretty good too. Um, but what happened is bonds, stocks like this, because then they think, okay, the economy's going to get chugging along a little better and going to help us improve, and inflation's still not really an issue. And that helped the stock market to do fairly well. But the bond market likes it when quantitative easing does not happen. Because basically, you look at a dollar bill, if it's harder to get, which means interest rates are higher, or banks aren't as willing to lend it out, then it's more precious. Okay, the dollar tends to increase in value as interest rates go up because they're harder to get, basically. When interest rates are going down, or when there's a whole lot of dollars to be found, they're less precious, so the value of the dollar goes down. Well, translate the same basic scenario over to Europe. They're doing quantitative easing to help stimulate their economy as well, where they're buying the EU central banks over there are buying commercial notes, treasury bills, or not, they're not called treasuries, but notes, bills, and bonds, or buns over there. And that has a tendency to make the euro less precious. Well, some reports are starting to come out that the economy is really picking up steam over in the EU, and so they may cease with this quantitative easing program. And what happened is that made the euro really go up and German bonds really go down. And so that was kind of the big news on Tuesday that we had. That also fed over into the US market where US bonds were down. And anytime bonds are down, that means interest rates go up. So we're starting to see US interest rates climb. And this may be one of those things where the markets are actually leading the Fed in this case because bond interest rates, I'll bring up later on, we're starting to see them increase at the 10, 20, and 30-year level. And the Fed may have to raise interest rates, the short-term interest rates, which I think are currently at 1/4%. They may need to bump that up just to keep up with what the bond market's already doing. So we'll have to see how that plays out over the summer and through the rest of 2015. On Tuesday, half of the sectors were positive, which leads you to believe that the other half were negative. But again, it was kind of a slow day. But since it was a down day, volume increased overall. It didn't increase in the S&P, and on Tuesday's video I pointed that out, where volume actually decreased in the S&P 500. But for the total market, volume increased over Monday. Both were still below average. But again, it's part of this bigger picture that we're seeing where more intensity, more enthusiasm is being shown when we have down days rather than up days. And in a healthy environment, you want upward movement confirmed by strong volume. And we're just not seeing that day after day after day now. Then on Wednesday, the S&P had a modest gain. I picked this out at the time. It's kind of become irrelevant, but the Russell 2000 had a strong day, and it's showing up a little bit more in our weekly charts that I'll go in later, where the mid caps and the small caps are still holding up fairly well, and that's positive. It's the large caps, the blue chip companies, where we're seeing a lot of the warning signs right now. But on Tuesday, the Russell 2000, it didn't hit an all-time high, but it did have a good day where the rest of the market lagged behind. Then, the situation in Greece continued on Wednesday, saying that it won't make a payment on Friday, which it didn't do. And if you're interested, as I'm reading articles about this and other things concerning the market, I post it on the Growth Concepts public Facebook page. I just share it out on the timeline. I also do that. I send out tweets as well, and I'm starting to post things on Growth Concepts Google Plus account as well. And I'll be adding other forms of social media here pretty soon. So if you want to, and I don't have any trouble sharing what I'm reading. So if you want to keep up with what I'm keeping up with, then please, either if you haven't friended me already on Facebook, go ahead and do that, or set me up as a follower on Twitter. And as these new other types of social media come out, I'll let you know about that. Different people prefer different types of social media, so I want to have Growth Concepts available on all the different platforms. Um, but yeah, I've been reading a lot of The Economist this week, Bloomberg and Business Week, which merged over a few years ago. Some articles there, and then my favorite geopolitical website is called Strat4. And there are a lot of free articles on Strat4, but to get the really in-depth analysis, it does require a subscription. But to me, it's well worth it. You find information and analysis there that's pretty much factual. They don't really have an agenda. They're just stating what's going on. They have very good writers. They do very good research, and I would trust them over a lot of the other sources. It's where people like Rush Limbaugh, Glenn Beck, Sean Hannity, Bill O'Reilly, it's where these guys go to get their information, and then they report it on their various shows as well. So it's a very good site. And I don't have any connection with them, so if you join up, I don't get any kind of a kickback or anything. It's just an information source that I found very valuable. And then on Wednesday, with the modest update, volume was below average, and we saw 6 out of the 10 sectors um, up on that day as well. And bonds had a really rough week. And when we get to the charts, I'll show you some more of that. Then on Thursday, we had kind of a pretty significant down day for the Dow. It really didn't have a big downward movement as far as price, but it broke through that short-term, pretty significant support that we had been seeing, and it fell below, which also is the 50-day moving average. And that's pretty significant. And I've now changed our short-term outlook based on moving averages to down because we didn't come back above it on Friday. We are comfortably down below that right now. So until we come back above that, I'm keeping the short-term outlook as down. Intermediate and long-term, based on moving averages, are still positive. They're still holding up okay. Short-term, we're looking negative. Um, on Thursday, no reported changes were made between Greece and the creditors. On Friday evening, which was Friday during the day, the Greek Prime Minister, who I have no idea how to pronounce his name, was speaking in front of the Greek Parliament, and the Greece market just got hit on Friday. So I'll bring up a chart of that later on. And then what also came out on Thursday, which you would think would really help give some support to the bond market. Wow, car needs a muffler. Um, the IMF came out with a report stating that they originally had US GDP pegged at 3.1% for the year. Well, they cut that to 2.5%. And also they insinuated in their release, the statement that they released, for the Fed to delay um, raising interest rates. Normally that would have really lit a fire under the bond market, but the bond market doesn't take the IMF as seriously as it does the Fed, and we've been showing some real weakness, and there's some the geopolitical things that are going on that had more of an impact. And the charts are telling a different story. So bonds are really starting to go down with interest rates going up. But on Thursday, bonds did rebound and had a pretty good day. But as when we show the chart later on, um, it was one of those days where bonds were up and stocks were down. All 10 sectors of the S&P that day were negative, and we saw a volume increase, which again is another signal that we continue to see day after day. Then Friday, the S&P had a modest down day. All the geopolitical and economic events had little impact on closing prices. We saw some pretty big impact through the night with the futures trading during the night overseas, and then some fairly good gyrations during the day, um, during the trading sessions this week. But when everything was said and done, the the close from one day to the next and 1 week to the next was not all that significant. Then it was finally released that Greece will delay their payment that was due Friday, June 5th, and they're going to bundle it with some other money that they owe on June 19th. So now we'll have to see, because they just kicked the can down the road, basically. So this whole story is still in play. It may go away for a few days, but as we get closer to June 19th, this is going to come back on the table. And other economic reports are going to come out, and the bond market's going to have this in the back of their mind the whole time. So the markets don't like uncertainty, and especially something like this, where you've got a country in play, which then feeds into the German bond market, which also then helps feed into the US bond market as well. Then we had the big employment report that came out where it was greater than expected, and they expected 225,000 new jobs. It ended up coming out with 280,000. That was quite a bit higher than expected. And now all of a sudden, the Fed raising interest rates sooner rather than later is back on the table. And there's even a little bit, they'd taken the June meeting off the table. Well, with Friday's report, now it's not, June isn't necessarily back on the table, but 2015 is on the table instead of waiting into 2016 to raise interest rates. On this news, bonds declined. This was much stronger than the bond market liked. 8 out of the 10 sectors on Friday were negative, But the Dow Transports, and I'll have a chart of that coming up, the Dow Transports actually showed some improvement. They're still not doing great, and they've bumped up into overhead resistance. But they had a pretty good couple of days this week where they'd just been getting hammered lately. And then volume was above average. Again, we had another down day with an increase in volume. So that's more the same story that we're seeing. So here's just to kind of recap all the economic reports that came out. If they're in dark blue, that means they're either at or above what was expected. The um, the ones that I have highlighted in bold are the ones that tend to be market movers. ISM came out on Monday, that was stronger than expected. Really nothing on Tuesday of significance. Wednesday was the ADP, amount of jobs that were added separate from the Fed. That came in about in line with expectations. Then we had a whole slug of other reports that came out Wednesday and even Thursday, but they weren't real market movers, with the big one then coming out on Friday. And this was the non-farm payrolls. Unemployment actually ticked up to 5.5%, which the markets really throw off as irrelevant because it's manipulated so much. The average hourly earnings were up 0.3% instead of 0.2. That was stronger than expected. The average work week was the same at 34 and a half hours. And then later on in the day, we had consumer credit, which increased by 20.5 billion, where they expected 16.8 billion. The original number was 17 billion, but they adjusted that. So yeah, well, what's a few billion, you know? So okay, but this just shows that consumer credit, people are going more and more in debt every month, and at some point, that's got to be dealt with, one way or the other. So here is the intraday chart. You can see a little bit of Friday's action from last week, and here was the close. I'm trying to put more annotations on the chart, and I'm hoping it's not getting too cluttered. But we started out the week to the downside, but then we saw an attempt at a recovery, but we didn't see a real follow through on volume. And what happened is price went right up to the resistance level it was actually the pivot level for Friday. And I made note of that at the time, that we're using levels from the previous day sometimes as resistance in this case. So we went right up to the previous day's pivot and then dropped into the close on Monday. Then Tuesday, we saw a pretty significant down open right down to the 2100 level. We tested that twice the previous week, the week after Memorial Day, and it held up pretty well. Well, we were able to bounce up off of that, and we went right up to the previous day's resistance level. So that's what these red arrows are for. This is a resistance level for Monday, but it was acting as a resistance level on Tuesday, and then we fell down into the close. And here's this little shaded area is the close on Tuesday. Then we had a positive open on Wednesday, and we went right up into this 2120 to 2123 area that I've shaded out now as overhead resistance. If we do get screaming to the upside, we're going to have to deal with this area. We ultimately went sideways and then fell down from this area, tried to show a little bit of recovery, but then drifted into the close. And I changed this little highlight thing here 3 times and it didn't make it through to the final version of this chart, so I don't know what's going on there. Thursday was kind of the significant down day that we had, where we shot to the downside, we tried to recoup, we went back up to the opening levels, and then took off to the downside. We danced along this 2100 level for quite a while, and then broke through on an increase in volume. That's pretty negative. So now that this 2100 level is now acting as resistance. It had been acting as pretty significant support, but we broke through that, then trailed off sideways on Thursday. Then on Friday, we had the negative open after all the economic news and the geopolitical news hit the markets. We came right down to, this was S1 or S1 on Friday, set up a little bit of a base, attempted a recovery, came right back up to 2100, dropped down into resistance again right around 2096, and then spent the rest of the day pretty much trailing sideways. It got pretty boring. after the first hour or so of the market. All the movement was seen. The high and the low range were set pretty early in the day on Friday, and people want to get going. At least out here on the West Coast, it's a beautiful weekend. In fact, I get to go sailing here right after I get done recording this video, and I assume people back east wanted to get an early start to the weekend as well, so we ended up drifting sideways into the close. Then here's the 30-minute chart for the week, showing a lot of the same things. Um, Here we had Monday's open, not a big difference from Friday's close last week. Shot a little bit to the upside, then to the downside. We closed, then we came back up, came back down. This is where we hit the upper level around the 2120 area to 2123, then came back down, tried to show a little bit of a recovery, then dropping. This is the big Thursday drop. But then pretty much through most of Thursday after we dropped and all of Friday, we ended up going sideways overall. Here's the hourly chart, which actually looks a little bit more negative, at least at the end here. A lot of sideways treadmill movement for most of the week, for the most part. And then Thursday, this is the big downward movement when we broke through 2100, and then sideways movement going into the close. Then to get into some of the daily charts, I'm still keeping this on the chart again just to give us some context, where the day after Memorial Day we broke through this support. That was the big down day on Tuesday after Memorial Day that we had, and now this is acting as overhead resistance. This is the 2120 to 2123 area that I have shaded out on the 10-minute chart, and we're going to have a hard time getting above that if we start going up. Then on Thursday we broke down below the 50-period moving average only to stay down below that level on Friday. So that's why I've switched the short-term view on moving averages now to down for the time being. But the blue line is still above the red line, so that's positive. And the red line continues to go up, but now we've dropped below based on price. So, and then I'm also pointing out the overhead resistance that we have at the 2120 to 2123 area. Then here's just a straight daily chart with the volume at the bottom, where we ended up closing down below the pivot for the month. And remember, these on the daily chart, these pivot levels are good for the entire month. So we're already negative as far as the pivot's kind of the central point. And if we're above the pivot, that tends to be positive. Now we're below the pivot, and that tends to be negative, and we dropped below that on the daily chart. And as we're dropping below, we're seeing a little bit of an increase in volume, which is telling a bigger story. This is a weekly chart of the S&P, which we've been going sideways for pretty much all year, and volume typically is below average except for on the down days, and that's even showing up on the weekly chart as well. Then, and again, for a long time I really didn't use the 100-period moving average, but because we've been in a sideways trend, it seems to be coming into play right now. Both the simple and the exponential moving average, and again, I've explained this in previous videos, I explained this in our classes, the difference there, it's just how they're calculated. The 100-period moving average, which usually goes from 20 is kind of a key moving average, then you go to 50, then you generally jump to 200. Well, the 100-period moving average has kind of come into play because of all this range-bound action that we've seen most of the year. We came down just about to the 100-period moving average, no matter how you calculate it, and that is currently acting as support right now. So that's just another level to keep in mind right now. Right around the 2084 level is where the 50-period moving averages are at. Both, again, depending on how you calculate it. Then the bullish percent index, this chart really hasn't changed much from the week, where the S&P had been slowly moving higher overall, even though we've been seeing short-term weakness now. And there's a number of different ways you can interpret this chart. as we were going up, we're seeing the bullish percent index taper off and show a divergence. That's negative. When we're having down days, we're not seeing a lot of pickup and movement to the downside with the bullish percent index. That's positive. So there's a couple different ways you can look at this. And then another negative is when we have had modest up days, the bullish percent index is not really moving. It tends to go sideways. That's more negative. So there's a number of different scenarios you can get out of just this one chart right here. Then here's a weekly version where the S&P has been moving higher, but yet we're seeing a divergence on the bullish percent index. And then when we have had positive periods of time, the bullish percent index lately has been going sideways. So that's more negative overall longer term. Then here's the ooh, spyware. Gotta get rid of that. Okay. Um, and here's the trading range that we currently are in. We're back down into more of the mid-level area right now. And again, the same thing is true. That volume has been consistently below average, which when we're still not too far away from all-time highs, but yet volume has been below average, that's not a sign of real health. The engine's still running, but the gas gauge is starting to get near empty. And for some reason it didn't advance. Okay, then now this is interesting. The ADX it just crossed above 20. We haven't seen that in months. And the ADX is also showing signs of life as we're going down. So, and I say appears to be to the downside. When you watch this every day, and the only time you see this thing really start to turn up and move is when we have a down day. It doesn't just appear, but I'm trying to be more neutral with some of my language here because I have to have respect for the market, that I can't be real dogmatic. That's why I look at multiple charts to reach a consensus. Um, Nobody knows with the millions of players and the billions of shares that trade to say that this is definitely going to happen. You can't be that probable about things, or that absolute, I should say. There's probability attached to everything. Even me sitting in this chair right now recording the video, something could happen. We could have an earthquake. We could get hit by an airplane. There's always some level of risk. There's never absolute certainty. This side of heaven, anyway. So, but we are seeing some signs of life with the ADX as the S&P has been declining overall and putting in a series of lower highs and lower lows. So this is starting to really show some weakness where the ADX is now starting to show that we're in a trend. And then the higher this thing goes shows how stronger the trend is. Doesn't tell us the direction. It just tells us whether we're in a trend or not. Then the stochastics still suggest that we are moving down short term and have more room to go down before we hit an oversold condition. Here's a weekly version of the stochastics, which had been overbought and have now turned down and crossed below the overbought level and are negative. So longer term, the stochastics are negative as well. Then I introduced this chart a week ago. This is the daily parabolic stop and reverse, SAR. This is also showing that when the dots are above the bars, that means we're in a downtrend, and that's continued now for some time. Then here's a weekly version of that chart, which is still suggesting on a weekly chart that we are still positive in an uptrend. We continue to fall much more. A little dot next week may appear over top, and that would signify a change in trend. Then here's a new version of an indicator that I've used for quite some time. I'm not a huge fan of Bollinger Bands, but I still like to look at them. And I actually have a signed copy of John Bollinger's book. Ooh, don't you want to just borrow that from me and read it? Yeah. And I think I got it used. It's kind of funny. But typically, this is his version of a moving average envelope where you plot standard deviations to the upside and to the downside, and then you have a midpoint. And price tends to want to stay near this dotted line. It acts like a magnet. Once it gets too far away, it tends to reel it back in, kind of like a dog on a leash type of a thing. You don't want your dog getting too far away. Eventually, you need to get your dog back close to you. Well, these this envelope, these lines move as price moves, and when they start to hit one extreme or the other, that sometimes signifies that we've gone a little too far too fast, which is not difficult to calculate right now because we've been going sideways for so long. So we get any kind of substantial move on these things, and we're going to be hitting some kind of an extreme reading. But we closed inside of the band. I wouldn't put a lot of weight in this. Again, one of the things that I look at is how close these bands are together. And the closer they are, just signals that we're more and more in a trading range. When these things get, oh, love windows here, when these things really start to move far apart from each other, that shows that we're in a pretty significant trend, either up or down. But pretty much all of 2015, these bands have been getting closer and closer to each other. Then this is a weekly chart as well, showing that we're just about in the midpoint as far as the Bollinger Bands are concerned, but they've been getting closer and closer together as well, where back here in late 2011 and at other times these bands get pretty far apart from each other. But we've been in a pretty significant, well, a pretty healthy channel going up, but you can see how these lines are getting closer and closer together as we've been moving sideways longer and longer. Then here's this is the commodity channel index. I think that's what it is. I'm so used to using the acronym. This is a new indicator. I haven't posted this before. I look at it every day, but this is the first time it's making a debut appearance in the videos. And I'll just bring this up on an as needed basis. There's other charts too that are lingering in the background that aren't really telling us anything. So I'll just wait until they do, until I introduce them. This is an oscillator similar to stochastic, similar to the RSI, similar to other overbought and oversold indicators, but this has a tendency to take volume into consideration. And it was originally developed for commodities. That's how it got its name. But it also applies to stocks and stock indexes as well. And we're in the middle of May when we had that little bit of an uptick when we hit all-time highs. We went into an overbought situation. Well, with the weakness that we've seen since Memorial Day, the CCI has been going down and we're now into oversold territory. But this can stay in there for periods of time. So we don't just start to freak out once we go in here. Where this really makes a signal is when we cross back above this minus 100 line, or if we're overbought, if we come down below this plus 100 line. But it's like an oscillating fan. It only goes so far in one direction and then turns around and goes in the other direction. That's what oscillators do. And this is just another example, but this takes into account volume in its calculation. I have a number of these new ones to show you. Then this is the Chaikin oscillator, which again helps us to measure the trend. It doesn't necessarily help with overbought and oversold conditions. It can. Oh, gotta love Windows. Oh, I just love this. Isn't it great? When we get to extreme readings, generally up in the high 40s positive, and then around the low minus 40s negative, are kind of the extremes. But I tend to look at this more as what is the trend telling us? And it's negative right now because it dropped below zero, so that signals that we're in a downtrend. But it's also been showing divergence because we've been basically going up overall with the S&P, while the Chaikin oscillator, and I think I spelled Chaikin wrong, I think it's IN instead of EN, where it's been showing a divergence in here. So this is longer term. This is what we look at. Now some of this, again, I have to warn with every oscillator, some of these divergences are natural because of the way they're calculated. As these lower numbers fall off, they're no longer in the calculation. So the indicator itself has no choice but to diverge. So that's just, yeah, a lot of technical analysis folks like to point this out, but at the same time, it's just a mathematical thing that happens. So it's not necessarily telling you that there's a warning sign. It's just saying this is the way I calculate myself, deal with it. Well, we look at this and we notice it, but we don't we just combine it with other divergences that we're seeing as well. I tend to prefer looking at actual price and volume, the raw values, and showing divergence there, or the 52-week highs and lows. That's what I prefer to look at for true divergences. But again, we just want to make note of this as well. Then here's a weekly version where I'm going all the way back into 2011 here, and this is not a real, yeah, I guess you could say I, trend lines are so subjective. You could get 10 people with the same chart and say draw trend lines on this chart, and all 10 people would come up with something different. And there are some programs out there that will automatically draw trend lines for you, and that's probably a better way to go. But some of the folks that I read during the week, um, I'm like, where'd you get that line from? I mean, that's not right. That's not the right definition of things. You're just, baking a scenario into a conclusion that you've already come up with. And so I want to be clear that when I do that, that I tell you that this you could make other trend lines in here that are probably more accurate. I just wanted to show a point here. We've been going up with the S&P since 2011, but on a weekly basis, the Chaikin oscillator has been showing divergences and is going down. It's not below zero yet, but it is showing some weakness on the weekly chart. Then here's another indicator. This is the Chaikin money flow. Do you think this guy named Chaikin wrote a book and had some indicators in it? Yeah. And at some point when I create my bibliography, his book will be one of them. And there's some other like encyclopedia type books of technical analysis indicators that I would recommend that you make as part of your library. The only problem is, even on the Kindle version of these books, you don't get a lot of volume. It's not like they're bestsellers. So you end up paying 40, 50, 60 bucks for some of these books. So I want to be real careful and only recommend the books or check them out at the library. Some of the libraries are really good, and you can at least go to the library and scour through it, or go to Amazon and look at the table of contents. But because some of these books are pretty expensive, be warned. I paid 300 bucks for some books over the years and really didn't get much out of it. So it's because I don't know, they just overprice these things. These are like college textbook prices that you end up paying for some of these books. So, but here's the Chaikin money flow, which again takes volume into consideration, and it's not necessarily telling us all that much right now. I just wanted to introduce it. This is called a histogram, which is just a different way of charting. When this the negative numbers or negative bars are getting less, that means we're going positive. Then eventually we cross over one and they turn green. Well, then the green bars start to fall off and we eventually cross below zero and they turn back kind of a reddish color. Well, you can see for the last few months, the Chaikin money flow has been going sideways with the market. But we did turn over and go negative on Friday on the daily chart. But we did that also earlier in the week. So it doesn't really know what to do right now. It's not really, it's just confirming that we're in a trading range, basically. Then here's another one called the ease of movement indicator. And this also takes volume into consideration. Look at it kind of like physics, that an object in motion has a tendency to stay in the same motion until a force greater makes it change direction. I think I just butchered one of Newton's laws there, but basically when we're below zero, that means we're negative. When we're above zero, we're positive. And then we look at the direction of the line as well, and it's been going down. So this also it's a little more short term in its calculation, but get used to seeing this chart on a fairly regular basis. Then this is a weekly version of the same chart, which we actually have dropped below zero and have been showing weakness with the ease of movement indicator right now. So that's longer term negative. Then we have this is called the force index. also takes volume into consideration. Where like the MACD and the KST, they pretty much just look at price, where these other indicators take volume in there. And again, I include not only price but volume, and as showing us the enthusiasm as well, or the intensity of what's going on. And you also want liquidity as well. But we're dropping negative based on the force index, but and this also acts like an oscillator. It'll only go so far in one direction before it turns around and heads back the other way. But we're negative with potentially more room to fall. Then, but on a longer term basis, here's a weekly version of that same chart. We're showing weakness, but we're still positive for the time being. Then this is more the raw data that I like to look at, where and I've showed this lots of times, and it'll be in the newsletter and everything else, where we've been generally going up with the S&P and we're near all-time highs, but we're seeing a real divergence on the 20, 50, and 200-day moving averages, and they're negative, shorter term. We're seeing some real negativity right now with these, with more room to fall, especially on the 20 right here. It could actually, it's not showing an extreme reading right now. Then here's a weekly version of that same chart and showing pretty much the same scenario, where we're showing weakness longer term also, with more room to fall. We can still go down before this gets to be too extreme on all time levels. Not saying that we won't turn around, but we can get more climatic with things and still not be in a deeply oversold condition. Then here's our MACD and KST. They're both negative. They crossed last week, actually week before last, and continue. The MACD crossed first, and then the KST crossed last week. So they're negative. This is more intermediate term. And again, down here at the bottom showing where we're seeing an increase in volume on down days. Then here's another one. This is a very popular indicator. It's not one of my favorites, but a lot of people look at it. It's called I can't even say it. On balance volume. And basically, if you have a down day, the volume is down. If you have an up day, the volume is up. That's why it looks like a whole bunch of little teepees going along here, mountain peaks. But overall, we look at the general direction. Probably what I'll do is put some kind of moving average on here to smooth this out a little bit, to give us more of a signal. But it's been diverging as the S&P has been going up, and this is just showing that we're showing a pretty exhausted market right now. Then some of our other oscillators, the PMO, the price momentum oscillator, this is showing weakness on all different time frames, short, intermediate, and longer term as well, even though the S&P is still right around all-time highs. Then some more analysis on the weekly chart is showing also weakness and some divergence and weakness going back, actually back into December. You can look at this. So there's all kinds of warning signs out there, and we may, this week, with that breaking through of 2100, we may start to see the longer term warning signs start to come to fruition. Some of these may happen over the next few days, over the next few weeks, over the next few months, maybe even later on in the year. But these signs are just, and the list is getting longer. I'm not quite sure how I'm going to do the newsletter right now, because I might just say, here's a list and take your pick, and because they're all kind of telling us the same thing. Then here's just the PMO itself, where it's showing divergence longer term and is also negative. Weekly, showing the same thing. We've been diverging for quite some time. Again, I don't get real hot and bothered about that one, because it's part of how it's calculated. But it has been negative for quite some time, pretty much for all of 2015. So, but we're not seeing that follow through yet in price. We're just seeing the momentum slowing down and turning negative. We're not actually seeing price itself turn negative. Then here's different versions of the PMO, short, intermediate, long term, our volume studies that we look at. These are all negative and still have more room to fall. This is more shorter term here. This is a little longer term based on the weekly charts. Negative all across the board right now. Then our slope is down. This is another trending indicator that I used to couple with the ADX. I'm separating them now, and I'm going to have the slope be its own indicator. It's also another book where the ADX and the slope came out. I have the book somewhere. And it was very expensive, not very long, but gave some good information in there. And at some point, I'll post that on the website. Then this is a weekly version of the slope indicator where we're crossing over negative now as well. Then here, this is back to more shorter term now, where we're actually seeing a little bit of positive action in the participation index. Even though we had a down day, we're coming up off of Thursday's negative day. Friday we had a little bit more of a positive day where you can see this red bar on Thursday was significantly down. Well, we saw an improvement on Friday. There were still more stocks down than up, and there was more down volume than up volume, but there was less than there was on Thursday. So that's why this indicator is showing a little bit of improvement. And then this is the spread between the two, where we're negative, but then there are Bollinger Bands placed around here, which continue to show that these lines are still pretty close to each other, and that we want to go back up in near where this dotted line is. I know it's hard to see, but we want to go back into the mid part of this moving average envelope here. This is a weekly chart, also showing a little bit of improvement as well. So all is not lost. There are still some positive signs. I just have to dig a little deeper to find them right now. But nothing really matters if we don't get moving, if we can't break out of this range one way or the other. Then here's some other volume oscillators that we look at. This is shorter term. Showed a little bit of improvement on Friday after Thursday's down day. So there are some positive signs out there. They're not real strong, and they're going to need to see some real follow through on price, but there's a few good signs out there. At least based on our oscillators. Then this is a weekly version of the same chart showing a little bit of an improvement over last week. And I don't know what to do about this. As I save these charts as ping files, I might have to change the format that I save these to a TIFF file or something, because I'm losing, they're getting harder to see, both as I'm looking at them as well as on the video as well. Then here we go. This is the percent. Okay, I had to look it up. PPO, price percent oscillator. Sure, we'll go with that. Yeah, that sounds good. It's another oscillator similar to the MACD, KST, and so forth, where this is showing negativity, and we also have the histogram. As this started to cross over, it went negative as well. Then this is the Williams percent R index, which again can register readings for long periods of time, but it's showing that we're oversold on a shorter term basis as well. We saw this after Thursday, and then this area starts to get shaded in as we stay in an oversold condition. Then looking at the new highs and new lows, we've been seeing a real tapering off for quite some time. Most of 2015 we're seeing divergences here. Again, when we're hitting all-time highs, we want to see this green line really pegged near the top, and we're just not seeing that. The differential, we're seeing a real trailing off and negativity, and then longer term, we're also seeing a divergence and some weakness as well. Then here's the, this is the weekly chart. We're also seeing that same divergence on here. And I highlighted these areas as well, the divergence, and that they've actually turned down also. So daily gives us, more the intermediate term, more weekly gives us the longer term look. Then here's some interesting charts that I haven't posted before, but this is an indicator that Stock Charts has available. These are the number of S&P 500 stocks, the percentage, not the number, the percentage of those stocks that are above or below their 50-day moving average. So this isn't the number, this is the percentage. And we've been seeing a divergence for quite some time now, and this is really dropping off negative based on the 50-day moving average. This is a weekly chart showing the same thing as well, a real divergence as the S&P's been going up. And then these are the stocks that are the percentage. I keep saying number. It should be the percentage of stocks that for some reason they picked 150-day moving average on this one, which is a moving average I just don't use, but it's still, the S&P has been going up, but we're seeing a divergence and now a real breakdown longer term based on this indicator. And then here's a weekly version of that same chart, which is showing some real weakness as well. So these are just the longer term signals that we're looking at. This is part of the bigger picture that we're trying to form in our head right now, realizing that daily we might have to do some adjusting and prices may go up, but this is giving us the bigger picture that we need to see. Summation index daily continues to go down, and then weekly it's also going down. So that's more intermediate to long term as well, showing some real negativity. Then this actually is positive. This is Friday's action. This up here are the small caps. Okay, I always have to look at this. This is the S&P itself. Okay, sorry. This is the S&P up here, this top chart. I should put a label on here. Then you have the mid caps, the middle of the road size companies, and then you have the small caps. You see here how they were actually up on Friday, where the S&P was down. That's a healthy sign because small and mid-term, mid-cap stocks tend to be more risky and they tend to move quicker. So in a healthy market, you want to see the Russell 2000 or the small cap index outperforming the Dow and the Nasdaq. And you want to see mid caps also outperforming. A lot of times when we're really steaming to the downside in a bear market, it'll be the mid caps where you start to see the recovery happen first. Again, we're not in that environment right now, so I'll just wait until something like that plays out. But this is actually positive, where the mid and the small caps are actually holding up. Or is that small and that's mid? Whatever. This is showing some positive signs overall. There's a weekly version of the same chart, which is not getting a real signal from this, but it just shows that the mid caps and the small caps are holding up for right now. Then here's our Dow theory, and these are some of the biggest warning signs that I'm seeing. And I know I have my version of Dow theory, where we were seeing the Dow go up. We've seen recent weakness, and that's why I drew that other little trend line on here. But we saw a significant breakdown with the transports and in this shaded area. But this week was a pretty good week for the transports. But we have overhead resistance right now. We have to get this significant breakdown, which had been providing support, is now possibly providing resistance. So we'll have to see how the transports act this week. But we saw a pretty significant break in the utilities on Friday. So this is boding more for longer term negative. Shorter term it could be positive if the transports get some traction and go higher. But longer term this is still giving us a pretty negative scene to look forward to. Then this is a weekly chart where the Dow's been going up even though it's off of its highs. We're breaking down in the transports, but this area is now acting as resistance. But the utilities have also broken down in the weekly chart as well. So that's more longer term negative. Then this is another new indicator, and it's not really telling us too much right now, but the New York Stock Exchange has what's called the overbought and oversold indicator. And when we start to see extreme readings up here, that typically will signal either a top or a bottom. And I look at this every day, but I just wanted to throw this in here as part of the mix today. It's not really giving us a signal right now. We need it to get a lot lower if we're headed lower, or a lot higher if we end up ending higher. But this is just calculating the number of up stocks versus the number of down stocks, and then plotting it. I'm not 100% sure how it's calculated, but even though this is the S&P up here, which includes Nasdaq stocks, this overbought oversold indicator is based on the New York Stock Exchange. So it's a useful indicator to keep an eye on because it's telling us a little bit of a different story that feeds into the scenario that we're seeing. Then there's a weekly version, which we're showing some weakness, but still have more room to go down on this indicator. Then here is the famous point and figure chart. And this is just to show you really what one looks like at this point, where uh, there's no time axis on here. There's just price. And it might take it 10 minutes, it might take 10 days, it might take 10 years, but when the S&P is going up a certain number of points, that's when a new X gets drawn. Well, we started to see a decline, and when it declines a certain number of points, that's known as a sell signal, and that starts to register zeros here. And a lot of people swear by these, and I like them, and I go through the basics of how to interpret these charts and what these little numbers mean. This 3, 1, 9, a B, a 6, a 5, and all this stuff. What all these things mean. I'm not going to go and this, I didn't draw this trend line. This is actually part of the software that it's actually drawing. So if we start to break down below this, that could register a pretty significant sell signal for the S&P itself. So we'll want to keep an eye on that. We're kind of at a critical point right now, and people that use point and figure charts are seeing that. But again, the big thing to take away from this is it's just measuring price no matter without having time as part of the equation. And then there's a lot of extra stuff you can take into this. And the bullish percent index is based on, because all 502 stocks that make up the S&P have a point and figure chart. And if when they are making new X's, those are new buy signals. When they're going down and making new O's, those are sell signals. And we're seeing a real drop off in that in the stocks overall. This is just based on the S&P 500 itself. So if we start screaming down and draw another zero here, that could be pretty significant. Then here's bonds. This is a daily chart where we saw a little bit of recovery on Thursday, only to give all that back on Friday. So bonds have been really having some trouble pretty much since the beginning of April, early to mid-April. That's when we started to see interest rates really go up as well. And this is a weekly version of the bond chart. This is the Vanguard ETF, where they take all the different bonds and bundle them together, and you can trade this just like a share of stock as well. And some of you may choose to get into something like this at some point. But we saw a real breakdown on the weekly chart here with bonds overall. So their bonds are having some trouble these days. And just to go in conjunction with that, this is the interest rate. This is the yield on the 10-year bond, which is up to 2.41% right now, and above the 200-day moving average as well. So that's pretty significant. And here's the 20-year, which we're back up to 2.87, which we've been at before, and the red moving average is crossed below the blue, or crossed above the blue right here. This is the 20-year. And then the 30-year is back up to 3.11, an area that we were at before. But it just shows you overall that interest rates are starting to trend higher now. Then here's our sector chart for Friday, going back to the beginning of the year, which still shows healthcare in the lead to the upside, with cyclicals coming in second, and then the utilities have just been getting hammered. Where we have the telecom, which again I talked about in the daily video, I may end up dropping that because I'm just not seeing the liquidity in the ETFs or the options. So I may drop this back to 9. I'm still playing around with that idea. So this is what I again want to stress, is that you could be implementing bullish strategies, ETFs that go up, enhanced ETFs or juiced ETFs up here. You could be implementing bearish or inverse ETFs or mutual funds down here, and you could be doing sideways strategies with these different sectors, and they're very liquid. You can get in and out of them quickly. You can set up different option strategies based on what's happening. And these are fairly conservative strategies. And you can also get into some of the futures contracts, which like the E-mini and so forth, if you want to just go stark raving crazy. That's more the living on the edge type of a thing. But so there's all different types of strategies on all different time frames that you can implement based on this. But this just gives you a view of the sectors overall. Then this is, and again, I stated this in one of the daily videos, that I'll only bring up a sector chart if it goes up or down more than 1%, because that's usually my benchmark for kind of a significant move, is the 1% level. Well, the staples, which are things people have to have no matter what's going on in the economy, um, we're seeing some strength, and so we saw discretionary. Those are things that people can't, they don't really need, but they may want, like a second car or some kind of a membership, or maybe that extra vacation type of a thing that people can choose. That's discretionary. They can do that at their discretion. Where staples are things that you have to have: soap, shampoo, toilet paper, toothpaste, food, which kind of comes in handy. They've really been getting hit lately. So sometimes you may hear these referred to, um, well, not, the cyclicals are more discretionary. They cycle through the economy, where these are more standard things that people have to have. They've been showing some real weakness, and they were down 1.3% on Friday. And then the utilities, which this pretty much mirrors the chart, we really broke to the downside. We had some pretty good support happening, and I could have drawn a line on here. I usually don't annotate these charts here, but we really broke to the downside. As I introduce more strategies that you can implement in our classes, I may start annotating and putting some more notes on these charts. Then here, just because Germany's been in the news, we can see since the mid to latter part of April how the German interest rates have just pretty much skyrocketed overall. They, on an intraday basis, they almost hit 1%. This is just the end of day price here, and I have to wait long enough just to get that. And then here's the German bond market, just to show you. It's been doing pretty well, but it's starting to show some weakness, and then over the last few weeks, it's been going down a bit. I don't have any indicators or anything plotted on here. This is just a price chart. I didn't even get any volume with this either. So we're just looking at this on a price basis. Then Greece, just because they've been in the news, they got hammered again on Friday. They've been in a sideways trend, but they broke through. Maybe they still have some more support that they could still go through. But overall, if you invested in Greece a few years ago, you're not too happy right now. If you shorted that market, you'd be doing really well. But we saw almost a 5% decline in the market on Friday. So a lot of trouble going on in Greece. I don't have any of the Russian ones to show you. I don't really get any news out of Russia, and I'll just bring those up kind of as I find the charts interesting. But here's the week coming up where the list is a lot shorter, and we really don't have anything major until Thursday. That's when retail sales comes out, and that's a biggie. Um, and then there's the headline number that'll be coming out, and then they take the auto sales out of that and come up with a different number. So that'll come out on Thursday, and then Friday's a big day with the producer price index. That comes out as two different numbers. And then Michigan sentiment. Oh, there goes Windows. Michigan sentiment will also come out on Friday as well. So Monday there's nothing. Wednesday there's nothing. And everything on Tuesday through up until Thursday is really light. So we'll probably look more towards technical trading, geopolitical events, um, because there's not a lot of economic news until later in the week that could really send the market one direction or another. We may just end up doing this gyration around at the open, and then flatten off to sideways action as the days go on. We'll just have to see how it plays out. So this is a bit of a change where I changed the moving average to down because we ended up closing Friday below the 50-period moving average, where we're still looking okay intermediate and long term. Nice crow outside. All three time frames on our oscillators are down right now. We continue to be range bound with 23 or 2130 My goodness. 2135 to the upside and 2040 to the downside. So that concludes the weekend update. So I hope everybody, at least if you're in the Pacific Northwest here, you have a beautiful Saturday to go out and go sailing. Doesn't that just sound like everyone should do that? I think we're not going to be the only people on the water today. So have a great day, and I should be able to prepare another video Monday. So we'll talk to you then.